Hello and welcome. This is the Insurance Pro Blog Podcast. This is episode 466. I am Brandon Roberts.
And I am Brantley Whitley.
Curse me, that's probably the first time I've said the episode number in a long, long time. And I don't know why I did it, but I did it nonetheless. You're listening to the internet's favorite podcast about life insurance.
That's right.
Mm-hmm.
That doesn't actually show you the episode numbers anywhere other than Brandon saying them. So
Yep. So I'm just going to start making them up. Welcome to episode 722.
We'll get there eventually.
Yeah, we will. We will. At this rate, we will. So today we're going to talk about life insurance. We're going to talk about life insurance. We're going to talk about retirements. We're going to talk about plans.
Mm-hmm.
You put those
and
all
LIRPs.
Together.
We're going to talk about LIRPs.
Put that all together, you get a really weird acronym that's really not that fun to say. It almost sounds like it's a dirty word.
You got the LIRPies?
I suppose.
Sorry. Sometimes it just comes out. We are actually serious.
Yeah.
People are like,
look,
are these the comedians of insurance?
Listen, it's insurance, people. If we don't do this on occasion, everyone's just going to die of boredom.
That is true.
Yeah. So the life insurance retirement plan is what we are here today to talk about. Why? Well, because we haven't addressed it in a long, long time. And it's worth noting as a way to explain what it's all about and why we have a certain beef with the whole idea.
Well, it's one in a long line of beefs, but yeah.
Mm-hmm. Mm-hmm.
I mean, there's investment grade life insurance and a 7702 plan. And what are some other ones? All the various banking monikers. The truth is, we just want to bring this up because there has never been a podcast episode or blog post that we have written that has caught us more hell than attacking the 7702 plan. And we figured, why not try again? I'm being serious. You have no idea. We used to have a phone number on the website. I would get phone calls at like 2 a.m. with people wanting to fight about the 7702 plan. We don't need your 2 a.m. drunk dials about 7702 plans. Okay?
We do not.
Call your ex-girlfriend that you shouldn't call instead. Yeah.
Yes, do that.
I mean, 7702 plan, that's one of the more egregious ones. But anyway, we're going to talk about...
But I find it in the same category as the LIRP. Like, we're trying to give it officialdom.
Yeah.
And that, like, it's life insurance, people. We're using a unique aspect of life insurance to help you build a more secure retirement. But we don't want to say life insurance because that's just a bridge too far. So we dress it up as something it's not, some special plan.
Yep. And
that's really the issue.
Well, basically everything that we've ever written or talked about is that we just don't use the silly name.
Right.
It's a silly name.
Exactly. To me, the risk is when you see somebody refer to it as a life insurance retirement plan or a LIRP or a 7702 plan or investment grade life insurance, they're trying to add a degree of buzz and sizzle to this thing that for whatever reason is here because they've decided they just can't sit down and talk to you like a normal human being and tell you, hey, life insurance is one of the things that you could use as a way to accumulate and store wealth.
Right. That is true.
I mean, I'll go so far as to say they might think you're too dumb to understand that you could do that. Or maybe they're too dumb to understand how to talk through it. I just, it's a really salesy thing to do in my eyes.
Yep.
And one of the issues that comes up frequently is the fact that this, every industry has people who just want to sell a thing.
Mm-hmm. Mm-hmm.
Right? Whatever it is. And they'll try to package that thing in some sort of whiz-bang special way.
Right.
And for sure, in the life insurance world, we get people who are generally newly licensed to decide, hey, I like the money I make when I sell an indexed universal life insurance policy.
Right.
So I'm going to ready, fire, aim this thing and go around and tell all my friends and family and anybody who will listen to me for 2 minutes about the LIRP.
Right.
And
yes.
that's a bad idea.
Yeah, I mean, LIRP actually has no official definition.
No, it does not.
It's just contrived.
It's a made up thing. And it's that's not to say that life insurance as a retirement component is a bad idea. We don't have any issue with that. We've spent I can't even do the numbers right now in my head, 15 years talking about that on the internet.
Yep.
And more years than that prior talking about it off the internet with people.
That's
totally
right.
Fine.
Lots of kitchen tables.
Totally fine with all of that. But when you start to use this very salesy stuff, it tends to skip over important stuff.
Right.
Like we both have a little bit of experience in the working with other agents to help them facilitate the process of selling policies.
Mm-hmm.
And
True.
We have seen them come and say, hey, I'm selling this LIRP. And you look at what the proposal for life insurance is, and you go, ooh, that's not even close.
Not only are you saying what you're doing it badly.
Mm-hmm.
Like the execution is poor.
It is. And it's, I suppose the big issue is, by my estimation, like 90% of the time, purely this happens out of incompetence. Like the idea that there are these calculated, nefarious agents out there who are just trying to screw you because
You're
they're trying to
giving them way
make
too much credit.
No. They're
You're
doing
giving
what they're
people
doing because
way
they
too much
don't know what they're doing.
Right. Exactly.
That's what it comes down to. And that's some of the dangers that are associated with trying to call things the life insurance retirement plan or the 7702 plan or any of those things. Now, now that we got all that complaining out of the way, let's try to be helpful and explain to people what this is, provided you're going to do it.
Yeah.
So there is a virtue, there is a reason people would use life insurance as part of their retirement plan. Now we will dive into what that is. Understanding that if somebody calls it a special plan, that's dumb. They should just call it life insurance. So, generally speaking, if we are executing a life insurance retirement plan, we are buying a cash value form of life insurance. So term insurance is out.
Yep.
And most of the time, the people who market LIRPs are talking about indexed universal life insurance or whole life insurance in some cases, but indexed universal life insurance the majority of the time. In some much rarer situations, we might see variable universal life insurance come up.
Perhaps.
Now, critical to the concept is a cash value life insurance policy that is, one, designed to accumulate cash, because not all permanent policies are designed to accumulate lots of cash. They're designed to create permanent low-cost death benefit. Yep. So step number one, we need maximum cash potential from the start. Then we need something that is what we will call overfunded or maximally funded, which we'd spent an entire episode on just a couple weeks ago. So what that means is we are giving the insurance company way more money than they asked for to put the death benefit in force. Why would you do that? Because all of that money goes to cash value in the policy and grows at whatever the contractually growth mechanisms are of the cash in the policy. For whole life insurance, that's guaranteed interest and dividends. For indexed universal life insurance, that's the indexing accounts. And for variable universal life insurance, those are the investment accounts that are inside the product offering.
Yeah, right.
That is a non-negotiable aspect of a life insurance retirement plan.
Yep.
You must be paying way more money than you need to pay into the policy. Because if you are just paying kind of the minimum required premium for the death benefit, you're going to have a very, very underwhelming result from a cash accumulation standpoint.
Right. It's not going to look much of a retirement plan, quote unquote.
Well, it will work as a good retirement plan for somebody involved in the transaction, but it won't be you.
That's right. Kind of like Kyle Busch. It was a great plan for the agent. Not so much for the Bushes.
Yep. That is very true. That is very true. So when it comes to product selection, whole life, index universal life insurance, variable universal life insurance, generally speaking, the differentiator comes down to risk profile of the individual.
Right.
Now, that's an idealistic way of putting it. Lots of times it comes down to which one the agent sells or which one the agent likes selling the most. But ultimately, the decision should come down to the risk profile of the individual.
Mm-hmm.
They break down very simply. Whole life insurance is the least risky, safest, lowest return expectations.
Right.
Index universal, well, actually, let's say it this way. Variable universal life insurance is the most risky. In theory, highest return prospects, though empirically that hasn't really played out. And then index universal life insurance sits somewhere in the middle.
Right.
Closer to whole life insurance in terms of risk profile. But honestly, a little closer to variable universal life insurance when it comes to rate of return anticipation. So we've spent lots and lots of time outlining the fact that whole life insurance is a very, very stable year-over-year growth engine, so to speak.
Mm-hmm.
Never going to blow you away. But we would expect long-term somewhere in the neighborhood of like 4 to, in some circumstances, if you're young enough, 5% year-over-year rate of return.
Right.
And highly unlikely to break considerably out of that territory, but also never going to have a year where growth is zero.
Right.
Because contractually, whole life insurance cannot do that.
And that year-over-year rate of return is calculated over a long period of time.
Yes.
You're not going to get
happen
5% the first year.
We're talking 20 years out plus.
Yeah.
Index universal life insurance, much more varied in terms of what's going to happen because we are tied to an index, which could be down, which would be a zero credit year.
Yeah.
You get nothing in that case. And the thing to be careful about with index universal life insurance, especially in the context of life insurance retirement plans, is there are a lot of people out there who can be extraordinarily aggressive with what they want to assume is going to happen inside the index universal life insurance policy's cash value.
Right.
This has gotten a little bit better over the past several years because some regulations come along that's tempered expectations. But we still live in a world where we can be quite optimistic, shall we say, about what we think is going to happen with the cash value in the policy.
Yep.
And sadly, I think this is done largely because certain people want to convince you that you should stop doing what you're doing, which is probably something like putting money in your 401k or money in your IRA. And you should start putting your money in a life insurance retirement plan.
Right.
Which
they set up a false dichotomy out of the gate.
Yeah.
They're comparing two things that shouldn't be compared.
Correct. So you
I should say we compare those things all the time, but we do it academically. We're not doing it in client situations with people going, you should do this instead of this.
Mm-hmm. Mm-hmm. Our approach to this is to show you where it fits risk profile relative to the other things that you're doing. But you can probably tell, we haven't said it directly, I'll say it now, we're not a big fan of telling people, hey, you're putting $20,000 a year to your 401k. That's great. But for all these kind of fictitious reasons, you should stop doing that. Start putting all that money into a life insurance retirement plan.
Right.
That's not something we are generally super in favor of. If you're looking to save more money than what you are currently saving, then life insurance may be a good complement to what you're doing inside your 401k. There's a large argument to be made there. But the aggressive assumptions about index universal life insurance are usually done that way so that the product compares more favorably against something like the mutual funds inside your 401k.
Right.
But those assumptions are very lofty and very, very vulnerable to
and
being
wrong. The framing is just off completely. Like,
okay,
life insurance discussions, we talk about rate of return expectations in a general sense to try to frame expectations. But if you're approaching it from, you need to win some rate of return battle, then your entire scope is off, because that's not where this fits at all.
Do we think that index universal life insurance has any chance of beating rate of return inside most people's 401k, provided that they're invested in something that's like broad stock market?
No. Over time, no.
There you go, people. That's the issue. Like, it should not be an us versus them discussion.
Right.
Because stocks should do better.
Right.
The world is upside down.
It should be
if
an
they don't.
us and this and these other things.
Mm-hmm. Now, at the same time, we have variable universal life insurance, which has exposure to some of these investments, but in general also comes with the heaviest layering of fees of all the insurance contracts that are available.
Well, now you've put it in the same risk profile as your other investments when you do that.
Yep.
So now you've diversified in product, but you haven't diversified in risk profile.
Correct. And you've arguably introduced some tax benefits to that money.
Yeah.
Because it's life insurance.
Sure.
But risk profile is still very high, and expense profile is substantially larger than what you probably have in your brokerage account or even your 401k.
Yeah.
Which makes the rate of return different, or the benchmark return you need to hit higher inside the life insurance contract, which is difficult to do.
And we don't offer VUL. We have nothing to do with it. So
nope, we don't.
So therefore, we don't talk about it, except in a general sense.
Right. Like this has to be part of the conversation. Now, expenses, for what they're worth, whole life insurance, we're never going to know what they are because they're just not disclosed. Universal life insurance, we do know because they are delineated. We can see them unfolding. We should transition to why people do this to begin with.
Mm-hmm.
So there are a number of tax benefits that life insurance offers.
Yes.
And there are a multitude of other investment style vehicles that have some of these things, but they don't have all of these things together.
Right.
So life insurance allows you to grow cash tax deferred.
Right.
It allows you to access cash without a tax liability. And it allows you to pass the money on through the death benefit income tax free to whomever you want.
Right.
So
pretty sweet deal.
That is. And in addition to that, life insurance contracts do not have the same contribution limits that would exist with official retirement vehicles.
Right.
So IRA limitations, 401k or 401k style plan limitations, those don't exist with a life insurance policy. The contribution limits of a life insurance policy are far, far, far larger. They're not set by any kind of regulatory mechanism. Instead, they're more set and guarded by insurance companies based on what seems appropriate for the individual in terms of affordability or reasonableness of the death benefit that's going to be put in force.
Right.
Which is a whole long way of saying, in theory, the contribution limit on a life insurance plan could be many, many, many multiples of what you're allowed to put into a 401k.
Yes.
We have put policies in force for people that have hundreds of thousands of dollars a year in contributions.
Mm-hmm.
You can't do that with a 401k.
No. And the guardrails are pretty simple. I mean, if a life insurance company looks at you and you claim you make, in the application process, there's lots of financial questions. If you claim you make $100,000 a year and you want to put $500,000 into a life insurance policy that's going to create a $20 million death benefit, you're going to have to do some explaining.
Mm-hmm.
They're going to want to know more.
Yep. But if you make 100,
I don't think that's suitable for you.
But if you make $500,000 a year and you want to put $85,000 a year into a life insurance policy, the insurance company is not going to give you a whole lot of hassle over that.
Probably not. No.
Not unless you happen to have $50 million of outstanding death benefit currently. And then they're going to wonder why you need more death benefit.
Right.
But that's the practical application here. There is a much, much higher capacity to put money away. In addition to that, the limitations for accessing money or forcing money out of the account don't exist with life insurance policies. So the 59.5 requirement that avoids the penalty tax for early distributions on IRAs, 401ks, even Roth IRAs, unless it's a recovery of basis, does not exist on a life insurance policy.
Right.
So if you are planning to retire early, very early, life insurance could be one option as far as avoiding that limitation. In addition to that, something that people don't think enough about, if you are higher income and you need to access some of the cash in whatever account it's in that has some degree of taxable liability to it, being in a high income tax bracket can make accessing that cash a little bit more problematic because it's going to potentially create more tax liability to you. Life insurance policies not having that issue means you can access the cash for whatever purpose without adding to your already large tax burden.
Right. Which is becomes a big concern for people after they're retired.
And there's also no required minimum distribution on a life insurance policy. So there is no forced money coming out.
Right.
And because we have income tax-free distributions from life insurance policies, we don't add complications to things like taxable Social Security or IRMA when we take distributions from a life insurance policy. Now, to be totally fair, we also don't have those problems when we take money out of a Roth IRA.
Right.
So they work very, very similarly in that sense. We should note, because we mentioned already, that you absolutely need to be overfunding the policy. The other thing that you absolutely do not want to have happen is turn your policy into a modified endowment contract.
Yeah.
So
then all the favorable tax treatment goes away.
It does. It renders it pretty useless at that point. You should also know, for what it's worth, that distributing money from a life insurance policy usually makes use of loans. And in order for loans to not be taxable income, the policy must remain in force.
Right.
So if you cancel the contract or lapse the policy because you take out more in loans than you have in cash value, which is not that easy to do, but still a possibility, you would potentially cause a big, big problem tax-wise with your life insurance retirement plan.
Right.
So having said all of this, we should probably identify who the right and wrong candidates are for this.
Sounds like a good thing to do.
In general, people who are higher income are better served by this application of life insurance.
Why do you say that?
Because they already have, or they do have, a real tax liability. If you are of lesser income, the amount of tax liability you have is generally pretty small. And it's likely to stay that way once you get into retirement.
Right.
If you are higher income, you likely have become accustomed to a certain lifestyle that's going to necessitate a higher income in retirement.
Right.
Not everybody's going to be in this boat, but a lot of people tend to be. So if you're going to need more income in retirement, it would be beneficial if you could shield some of that income from tax liability.
Right.
And life insurance, as well as Roth IRAs, are a way to do that. You do run into a little bit of a problem being higher income and having capacity to save money in Roth accounts.
Right.
And those limitations don't exist when it comes to life insurance policies.
Yep.
So
very
higher
true.
income individuals. You also need to have some degree of need for the life insurance.
You mean the actual death benefit?
Yes, correct.
Yeah.
So the idea that, you're just going to have some extra life insurance, kind of, sort of, but like if you cannot, under any circumstances, justify the additional death benefit that's going to be created by the life insurance purchase, it's hard. And you also need to be in a position where you can qualify for life insurance.
Right.
So if you are unhealthy and your policy either would not get issued or would be heavily rated, for example, or if you happen to be engaged in certain activities that create additional expense, like auto racing, you're not a good candidate for life insurance in this case.
Right.
Because those expenses are going to deduct from policy cash value performance.
Right.
And you also need a reasonable timeline. And I'll identify that as basically 10 years at the minimum before you intend to retire or start using the money.
Yep.
So
if you are 62 planning to retire at 65, life insurance is not a good idea.
Yep.
Not unless...
And we've talked to a lot of those people over the years, and we're always, I think they're disappointed, but we just tell them the truth. Like, not a good fit for you at this age and stage.
Not unless your circumstances are, well, I'm 62 and I want to retire at 65. But here's the deal. I'm sitting on $2.5 million. And I intend to take $1 million and live off that for a while. And I'd like to take another $500,000 and set that aside in something that's much lower risk, like life insurance. And I won't probably touch that until I'm like 75 or 80.
Right.
That's a path where we might talk about implementing life insurance. But that's the only situation where we would talk about implementing life insurance. And I'm still going to say, if you want something that's lower risk in the insurance world, annuities are probably a better bet.
Yeah. Very true.
The inverse is very true here. The people who really aren't good candidates, lower income individuals, in general, because there's just not much of a tax liability to make the tax benefits of life insurance all that worth it. For them, they may actually get a little more life-changing result from just investing in the market and getting the rate of return that's going to produce.
Right.
It's just a mathematical truism that if you make $50,000 a year and you save 20% of your income, if you can get the kind of benchmark return everybody wants to get on the stock market for a number of years, that might put you in a position where you can generate more income than you were making in that situation.
Yeah.
If you make $500,000 a year, even if you're saving 20% of your income, the growth of that account balance may not be enough to really change your life much in terms of what you'll be able to generate from income from that.
Right.
Especially not after taxes.
Right. 100%.
Individuals with very varied income are not great candidates because you do have to commit to paying the premium of a life insurance policy.
Right.
And while we can build lots of flexibility into these things to address occasional fluctuations in cash flow, that's absolutely the case. But if you're already low income and it's very, very variable, that sets you up for a very precarious circumstance when it comes to life insurance.
Yep. Absolutely, it does.
The other category that we don't talk enough about are people who truly, and this is a rare individual, but people who truly believe that once they retire, they will absolutely have a lower income need.
Mm-hmm.
So maybe they're making a lot of money right now, but they don't have a lot of expenses. And their intentions when they retire are to dramatically reduce the amount of income that they will ultimately produce from their assets. They may truly end up in a lower tax bracket at that point. And they're probably best benefited from maximizing all of their tax deductions right now.
Yeah. And that's sort of what the traditional financial planning world locks onto that.
Mm-hmm.
And you and I have not seen that in practice with most people.
No. Very few people fall into that category, but I'm not saying they don't exist. And that's an individual who's not going to be all that well benefited from what life insurance has to offer as a retirement tool. They may still want it for the safety profile. So it's not so much a tax issue, but more just it's a stable asset. I kind of like that. That's okay. But they are less of an ideal candidate in that circumstance.
Mm-hmm. Mm-hmm. They have most of the time, those people have no real plan to take it as income. They might if they needed it, but it's sort of a secondary source.
So we already hinted at the idea, and we'll kind of wrap up with noting life insurance is a complement to the other things that you're doing because it's a safe asset, but it's also an asset with a number of really great tax benefits.
Yep.
So you can use, for example, and this is just one example of many possibilities. You could use life insurance early on in retirement to create income that doesn't carry much of a tax liability, doesn't carry any tax liability to it. And that might give you some flexibility to do things like Roth conversions if you want to.
Right.
And that might also put you in a place where over time, you might decide to de-risk some of that Roth money and put it back into life insurance by paying down the loans that are outstanding.
And the whole idea here is you're going to stay in the Roth and in more aggressive investments to take advantage of the growth opportunity that presents. But eventually you're going to get to a point where you decide enough is enough there, and we're going to pull back and move it back into the life insurance policy. And because of the taxable nature of those things, you don't have to worry about tax problems creeping up because of the way you're distributing money. You're using two non-taxable accounts. You're just benefiting from the different risk profiles and expected rate of return profiles those two things would have.
Right.
There are a number of ways, though, to coordinate the tax features of life insurance and the risk profile of life insurance with your other assets. And that's what we are very good at doing here. And since we didn't mention earlier, we should say that if you're listening to this and you've decided that despite all of our bad mouthing of the idea of a life insurance retirement plan, just for the sake of calling it a plan, you'd really like to do this, you should head on over to the Insurance Pro blog and contact us, because we could talk to you about how you do it.
Schedule an appointment to have a conversation.
Yep.
You can rest assured, we no obligation and no pressure. It's just a conversation.
Yep. We might make some corny jokes along the way. We might not. You never know. Depends on the mood we're in that day.
Depends on what you want.
Anything else?
No, I don't have anything else to add.
Okay.
I'm all done.
Well, again, if they present it as a plan, be careful. Be very careful. If they present it as life insurance, they're a lot more honest than several, and that's a good sign.
Yep.
And design is critical. So with that,
I was going to say, just make sure you get the right product and it's set up properly.
Yep.
That's going to affect everything down the line.
Which is difficult to know. Everybody asks, how do I know? Ask more than one agent.
Right.
Ask us. That's why we're here.
Yep.
And with that, I am Brandon Roberts.
And I am Brantley Whitley.
And we will see you next week.